Did we miss the train? Did we miss the train where all the good stuff in the crypto market was kept? It doesn't seem so. We're in on a single train, and in it is a mix of good and bad stuff, and most times the bad stuff surpasses the good. Bad stuff is in the form of terrific meltdowns, price crashes, market blows, unexpected dips, and so on. Simply put, these situations are what investors conclude to be manipulations. The history of crypto has been defined by 5 resets. The first came in 2014, when what was considered the only Bitcoin exchange in the world, Mt. Gox, imploded, following a nearly $500 million hack. The second in 2016 was the DAO hack, when an attacker tricked a smart contract into giving away $60 million worth of Ethereum. The third, in January 2018, hit us badly, which is when the ICO bubble popped, starting a year-long decline, thus wiping out 60% of the crypto market, or more than $700 million, mostly in the form of worthless junk tokens. The fourth took place in March of 2020, when crypto lost 40% of its value, along with most of the other global financial markets. Well, these resets have not only resulted in price market capitalization increases, but they have equally cleared the way for rapid innovation. The two biggest exchanges in the US, Coinbase and Kraken, experienced a beauty out of the ashes moment since they were established from Mt. Gox's implosion. Back then, the CEOs understood that people needed trustworthy places to buy Bitcoin. Wait, the fifth? Well, it started in 2022. There was a $1 trillion market collapse, which was caused by a steep sell-off in risky assets and the sudden evaporation of a $40 billion digital token called Luna that backed the $16 billion stablecoin Terra USD, or UST for short. In contrast to the free-floating Luna tokens, each UST was designed to be worth a single US dollar. A perfect storm of greed and immature technology led to the stablecoin losing its peg. What happens next? $56 billion disappeared into thin air. Poof. And what about the heart-wrenching bear market crashes? Bitcoin is only 15 years old, and the cryptocurrency market has had many severe crashes. The crypto collapse that occurred in 2022 was a reminder of how get-rich-quick schemes can overwhelm common sense. The Terra LUNA crash taught investors that not all that glitters is gold. Oh, let me reframe that. Not all that is decentralized is decentralized. Plus, the swift demise of cryptocurrency exchange FTX in 2022 damaged the cryptocurrency industry, stoking widespread mistrust among the public and toppling cryptocurrency services that did business with it. A lot has happened, and there could be even more. These events have been considered by many to be unfair situations that have cracked the credibility of the crypto industry, especially by old rich billionaires. One of the famous instances was Warren Buffett's comments that he called Bitcoin rat poison squared. Also, Jamie Dimon, CEO of the largest bank in America, called Bitcoin worthless and even claimed to fire anyone working for him if they invested in it. Moving forward, apart from the collapse and nerve-wracking events, crypto has become vulnerable to several legal issues. Unregulated markets have made it too easy for investors to take depositors' money, hide it, move it, or even lock it up in ways that would be illegal in other markets. The decentralized nature of crypto markets makes it easy for investors to manipulate prices. Applications designed to encourage speculative and uninformed investments often lead to more buying than an individual can afford, and crypto purchases are difficult to track, making them easy to use for criminal activity. The value of cryptocurrency is indeed not connected to any underlying asset, just like a company's performance. So the crypto market's unregulated nature means that it is too easy for bad operators to move or steal investors' money. Lack of regulation commonly leads to buyers not being as informed as they need to be when purchasing, as many buyers buy crypto without knowing what drives its value or of less risky alternatives. This economic reality makes the purchase of cryptocurrencies even more speculative and harder to predict. This inevitably implies that most of the times investors are to blame for the manipulations they face. Well, this does not erode the fact that large investors are also responsible for the manipulations that plague the market. Whenever you see crypto whales, it is better to flee before they swallow you up. But I hope this is not just a petty shift of blame for who or what is truly responsible for the manipulations of the market. The whole thing is as mysterious as the dark side of the moon. Do large crypto investors manipulate the market? This question was asked on Quora a couple of years ago, and one of the answers was quite thrilling. I'm a large crypto trader. The main thing that manipulates the market is God. Jesus Christ runs the whole show. He taught me how to trade, and all true investors will tell you the same thing. With that being said, investors come next. This response was posted by Christian Casarli. Of course, this was not the expected answer, so let's look at another one. A user identified as Coinsfera Globa wrote, "If something is doing good, it does not mean holders of it are manipulating the market. Large crypto traders buy because they think that Bitcoin will go up in the future. If it's called manipulating, then yes, they are manipulating." Okay, so this is what we have to say. Large cryptocurrency holders are called whales because they have much larger than the smaller fishes in the cryptocurrency ocean, and that's an obvious fact. It is normal for any action taken by crypto whales to be closely watched by investors. Whether they act intentionally to manipulate prices in the market is difficult to say, but they can cause prices to rise and fall because of the interest others take in their holdings. So if you are a crypto investor, it's a good idea to pay attention to what the whales are doing, but movement doesn't necessarily mean that you should panic. Many whales are business owners who have invested heavily in cryptocurrency, and they're not going to give it all up anytime soon. This is where surviving in the so-called manipulative space comes in. One of the ways to do this is to follow the trajectory set by legendary Richard Wyckoff. Have you ever heard that name? Well, notably, Richard Wyckoff wrote about financial markets in the early decades of the 20th century, at the same time Charles Dow, Jesse Livermore, and other iconic market analysis figures. His pioneering approach to technical analysis, known as the Wyckoff Method, has survived even into the modern era. Wyckoff's observations on price action align with what is known as the Wyckoff market cycle. This is a theory that outlines key elements in price trend development marked by periods of accumulation and distribution. 4 distinct phases comprise the cycle's accumulation, markup, distribution, and markdown. Wyckoff also defined rules to use in conjunction with these phases. One of Wyckoff's rules is that the significance of price movements unveils itself only when compared to past price behavior. Simply put, context is everything in the financial markets. The best way to evaluate today's price action is to compare it with what happened yesterday, last week, last month, and last year. But this is where most investors are missing it, hence the excuse of the market being manipulated. No doubt, many unpleasant situations have unfolded, but there are survival strategies within. According to Wyckoff's distinct cycle, the accumulation phase forms as institutional investors increase their buying and drive demand. As a result, more interest develops, and then the trading range displays higher lows as prices position themselves to move higher. It's simple given that with buyers gaining power, prices push through the upper level of the trading range. At this markup phase, a chart will show a consistent upward trend. Also, in the distribution phase, sellers are trying to gain the upper hand. The horizontal trading range in this phase will display lower price tops and a lack of higher bottoms. Then the markdown phase is a time of greater selling. It's confirmed when prices break below the established lows of the trading range. Once this 4th and final phase of the Wyckoff market cycle wraps up, the entire cycle will repeat itself. As noted earlier, the Wyckoff method is used by investors and traders to determine market trends, select investments, and time the placement of trades. It can help them identify the times at which big players are accumulating or distributing positions in a security. It can help users find trades with high profit potential. What's more, its straightforward analytical approach means investors can enter and exit the market without emotion that can blur judgment. Although crypto is choked up with many brute moments and manipulative influences, there have been watershed scenarios and some bright spots. Crypto has entered many more mainstream conversations as leading financial institutions are showing interest in digital assets, with the US government vocalizing its interest in its regulation and possible adoption. In previous years, many experiments, bold ideas, and untried concepts were squashed, resulting in wide-ranging reverberations across the crypto universe. But crypto will likely come back even stronger after the various collapses. But for the issue of the large investors manipulating the market, there's a survival strategy. Go Wyckoff already. If this video has cleared your doubts, then tap the subscribe button and ping the bell to be notified of our new videos.